Hey everyone, and welcome back. Today, we're cracking open a seriously fascinating document. It's known simply as the Manipulation Master Key. Think of this explainer as, well, your ultimate insider's playbook. You know that feeling when you're looking at a financial chart and you get this sneaking suspicion that the market is actively plotting against you? Yeah, we've all been there. Well, according to this source material, you might be spot on. Today, we're going to strip away all that retail noise and uncover the hidden mechanics actually driving market movements. All right, let's just dive right in. So here's our roadmap for today. We're going to cover 1. The illusion of the market, 2. Mastering market liquidity, 3. Decoding institutional zones, 4. Spotting the foo candle, 5. Exploiting market imbalances, and finally, 6. Executing the perfect trade. Okay, section 1, the illusion of the market. To really grasp this master key, we basically have to toss our standard retail trading worldview right out the window. The document hits us immediately with this brutal reality check. You must not trade against banks. Stop believing retail concepts. Basically, if you keep relying on standard, everyday retail strategies, you're pretty much just walking into a trap. You're making yourself the prey. It's honestly a pretty stark dichotomy. On one side, you've got the retail trader. That's most of us, right? Frantically trying to predict direction using, basic traditional patterns. It's kind of like a gazelle trying to guess which way the wind is blowing. But on the exact opposite side, the institutional bank. And here's the kicker. They aren't predicting anything. They're calculating. They calculate exactly where our retail stop losses are sitting. Why? To guarantee the retail side loses, which in turn secures the massive volume that they need to operate. Moving on to section 2, mastering market liquidity. So what exactly are these banks calculating? The answer is liquidity. But as this text points out, liquidity is way more than just your standard trading volume. It's very specific target zones. The author calls it the final area, where retail traders think they're winning. Institutions literally target these zones aggressively, like a giant vacuum cleaner, purposely trapping buyers or sellers just to fill their own massive orders. And you can actually see this vacuum effect happening in real time. Take a look at the areas marked with the pound symbol on this 4-hour chart. Those right there, those were the final areas of liquidity. Watch how the price sweeps down, snatches up that liquidity right where everyone conveniently placed their stop losses. And then bam, a perfect rejection. The market didn't need to drop a single pip further once it grabbed its fuel. But that leaves us with a really crucial puzzle. I mean, if liquidity is basically everywhere, which side of it will the banks go for first? And which side will they completely ignore for later? Answering that specific question is what bridges the gap between just, spotting a zone on a chart and actually calculating the bank's next major move. All right, section 3, decoding institutional zones. Now, the real key here is wrapping your head around how wonderfully counterintuitive this whole process is. The text lays out this 4-step science of what's called an order block. Step 1, banks actually sell heavily, on purpose, to force the price down. But why? Well, it sets up step 2. They actually want to buy a massive amount for the true upward move, and they obviously want it at a much cheaper price. Makes sense, right? But wait, now they're stuck with all those losing sell orders from step 1. So step 3, later down the line, price will naturally gravitate back to this original zone so those institutions can close out those initial sell orders at break-even. And finally, step 4, because a massive amount of sell pressure is just suddenly yanked out of the market, the price reacts incredibly sharply and just shoots straight up. It's crazy. They're literally selling just so they can buy. You can literally spot the heavy footprints of this institutional money when you zoom out and map things on higher time frames. Look inside that green highlighted box. That's our institutional zone, the order block. Mapping these guys out on a 4-hour time frame is an absolute game changer. Why? Because even if the price wanders away and revisits this exact area weeks or months later, it still holds massive relevance. Which brings us to section 4, spotting the foo candle. Okay, time for some visual evidence. Enter the delightfully named foo candle. This is a highly manipulative candlestick that essentially flags a deliberate liquidity grab. The source actually calls this the ultimate smoking gun. When you spot this specific candle forming, it's telling you exactly where the banks are totally fine leaving liquidity behind, and it exposes the true direction they're about to drag the market. let's actually break down the anatomy of this manipulation. In this specific setup, you see the price drop heavily into our institutional zone, right? Then it forms a doji. What that does is generate a nice little buildup of retail liquidity right beneath it. Retail traders see this, they start buying, they start moving their stops to break even, and then whoosh, the few candle sweeps down rapidly, taking out absolutely all of those trapped buyers. It snatches up the liquidity, and only then, after the damage is done, does the true upward move begin. It is a completely calculated trap. Next up, Section 5, exploiting market imbalances. So now that we've seen exactly how they harvest liquidity, there's another major phenomenon we can't ignore: imbalances. These are those sudden, pure bullish or bearish candles that leave a literal void in the market structure. The author makes a really compelling argument that these are often just tricks to fake out retail traders. They act like massive magnets. Check out the 4 imbalances in a row on the left side there as the price just flew up. Naturally, the price was eventually drawn right back down to fill that void, hunting for liquidity, before it finally resumed its path higher. And finally, Section 6, executing the perfect trade. So, how do we transform a risky, fingers-crossed guess into a highly calculated, sniper-like entry? Well, the text outlines 5 non-negotiable confirmations. First, you've got to identify that institutional zone on a high time frame. Second, wait patiently for the current price to form a doji. That's generating your new liquidity. Third, watch for the price to actually grab that previous liquidity. Fourth, look for your smoking gun, the FUD candle springing the trap on retail traders. And fifth, wait for the price to break and then cleanly retest that zone. That right there is your entry. Let's see all 5 of those steps coming together on a chart. We've got the previous zone mapped, we see our doji forming to lay out the bait, then that sudden sweep giving us our foo candle, and finally, look at that beautiful clean retest of the zone, giving us the perfect entry point. When you stack all these factors together, you are no longer trading against the institutions. You're trading right alongside them. And that's what leads to those incredible risk-to-reward ratios, because your stop loss is tiny and your target is absolutely massive. Look, this entire document basically takes a sledgehammer to everything most people are taught about basic trading. It paints a really vivid picture of a market perfectly engineered to hunt retail stops, entirely driven by banks that just desperately need liquidity to fill their massive orders. But the tools to survive it, they're right there on the charts. The order blocks, the fun candles, the magnetic imbalances, they're all hiding in plain sight if you just know how to look for them. So I'm going to leave you with a bit of a provocative thought. Now that you can actually see the hidden mechanics of this manipulation laid bare, what is your next trade going to be? Are you going to stick to those old retail habits, or are you ready to start using the master key? Thanks so much for hanging out with me for this explainer, and as always, keep learning.